Everyone knows Netflix. It is the most dominant streaming service on the planet, more than 300 million paying subscribers in nearly every country in the world, with shows and films that have genuinely changed popular culture. And yet, from its all-time high of $134 in June 2025, Netflix has fallen to around $86 today, a drop of 38% in less than 12 months. The business keeps growing, the subscribers keep coming. So what exactly went wrong? Today we break down the full story, what happened, where the company stands right now, and both sides of the investment case. The 38% drop did not come from one single event. It was 4 separate problems hitting in quick succession. First, the Warner Brothers saga. This is the story that defined Netflix's last 6 months, and most people outside of finance do not know it happened. In late 2025, Netflix launched an ambitious attempt to acquire key assets from Warner Brothers Discovery, the studio behind HBO, DC, Harry Potter, and a library of some of the most valuable content in Hollywood. The logic was sound. Netflix wanted to accelerate its content advantage in one move. But the deal quickly faced competition. Paramount Global, backed by Skydance and billionaire Larry Ellison, launched a rival offer and ultimately raised its bid to a full $110 billion acquisition of the entire company. Netflix declined to match the offer, stating the deal was no longer financially attractive, and walked away in February 2026. Netflix's shares had shed more than 18% from the moment it announced the deal in December to the moment it walked away. The market hated the uncertainty, hated the potential cost, and then actually rallied 14% the day Netflix exited, a clear signal that investors thought the deal was a mistake. Second, the Brazilian tax charge. In Q3 2025, Netflix reported earnings per share of $5.87, well below analyst expectations of nearly $7, mainly because of a $619 million one-off charge linked to a Brazilian tax dispute. That charge was non-recurring, but it triggered a sharp sell-off. Management also cut its full-year operating margin guidance from 30% to 29%, citing the tax hit. And when a high multiple growth stock cuts its margin guidance, the market reacts hard. Third, the earnings misses. EPS in Q1 2026 missed consensus estimates for the second time in 3 quarters. Netflix is still growing, but the market prices it for perfection, and 2 consecutive misses broke that narrative. And fourth, macro pressure. In recent sessions, the Nasdaq has dropped sharply on risk-off days, with crowded, high-multiple growth names like Netflix often leading the decline when traders move to reduce risk. With a beta of 1.5, Netflix moves harder than the market in both directions. When sentiment turned cautious in 2026, Netflix felt it disproportionately. Here is the important thing. None of those 4 factors actually broke the underlying business. Let's look at what the company actually looks like right now. In Q1 2026, Netflix delivered revenue of $12.25 billion, up 16% year over year, ahead of its own forecast. Operating income rose 18% to $3.96 billion, with the operating margin expanding to 32.3% from 31.7% a year earlier. Free cash flow surged 91% to $5.09 billion. The company then used the $2.8 billion termination fee from the failed Warner Brothers deal to turbocharge its capital return program. Netflix announced plans for a $25 billion share buyback program, an extraordinary commitment that signals enormous confidence from management in the company's intrinsic value. $6.8 billion of buyback authorization remains outstanding. Netflix reaffirmed its full-year 2026 revenue guidance of $50.7 billion to $51.7 billion, representing 12% growth, and guided operating margin to 31.5%. The average Netflix stock price over the past 52 weeks is $105. Today it trades at $86. The stock is trading significantly below its own recent average, which for some investors is precisely the point. The bull case for Netflix at $86 starts with one powerful observation. The business has never been stronger, but the stock has never been cheaper relative to its cash generation. Netflix generates record cash flows. Management raised 2026 free cash flow guidance to $12.5 billion from $11 billion. The advertising business is on track to roughly double to $3 billion in 2026, with advertiser count up 70% year over year to more than 4,000 clients. The ad-supported tier, priced at $8.99 per month in the United States, accounted for more than 60% of new sign-ups in advertising-enabled markets. This matters because advertising is a fundamentally higher margin business than subscriptions alone, and Netflix is only in the early innings of monetizing it. The bull case rests on operating leverage. As the ad business scales, margins expand, and free cash flow compounds. Live programming, boxing, NFL games, the World Baseball Classic is widening the moat. Netflix is expanding into content categories that were previously impossible on a subscription streaming platform, and each new category adds reasons for subscribers to stay. Wall Street consensus sits at a 12-month price target of $114, with 8 strong buy and 29 buy ratings. One analysis puts the bull case at over $330 per share within 12 months. 3 major hedge funds recently added aggressively to their Netflix positions at current levels. And the $25 billion buyback means every quarter Netflix is buying its own shares at a price management believes is significantly below intrinsic value. But the bear case is real and deserves a full hearing. The first concern is competition, and it has never been more intense. Disney, Amazon, Apple, and Alphabet are all investing heavily in streaming content and distribution capabilities. Disney has ESPN+, a sports rights portfolio, and theme parks that create engagement loops Netflix cannot replicate. Amazon bundles Prime Video with its logistics empire. Apple can afford to lose money on Apple TV Plus indefinitely. Investors are increasingly questioning whether Netflix's evolving advertising model and pricing strategy can sustain its next phase of growth. The ad business is promising, but it is unproven at scale, and Netflix is competing for the same advertiser budgets as YouTube, Meta, and TikTok. That is a very different game from selling subscriptions. Netflix ended the latest week under pressure, slipping through consecutive trading sessions, while the S&P 500, NASDAQ, and Dow Jones all closed at record or near record highs. A stock that cannot rally when the market is at all-time highs is a yellow flag. Co-founder Reed Hastings has been stepping further away from board involvement. Leadership transitions at companies built around a single founder's vision always carry uncertainty, and at Netflix, Hastings' content instincts were central to the company's identity for 30 years. And finally, the failed Warner Brothers bid leaves Netflix without the content acceleration it was counting on. Walking away from Warner Brothers limits content acceleration, and Netflix must now defend its organic growth story without the WBD deal as a strategic backdrop. Netflix is one of the most fascinating stocks in the market right now, precisely because the business and the stock are telling completely different stories. The business is generating $12.5 billion in free cash flow, growing revenue at 16%, expanding margins, and executing a $25 billion buyback. By almost any operational metric, Netflix is performing at the highest level in its history, but the stock is 38% below its all-time high, trading below its own 52-week average, unable to rally even when the broader market reaches record highs. The market is saying, "We believe in the business, but we are not sure about the price we paid for it 12 months ago, and we are not sure the advertising bet will scale the way management says it will." Three things need to break right for the bull case to play out. The forward multiple must expand as the market digests Netflix's new earnings power, ad revenue must keep doubling, and the $6.8 billion buyback must be deployed aggressively. If all three happen, the upside is enormous. If one or two disappoint, the stock could stay range-bound for longer than bulls expect. Whether Netflix at $86 is one of the great opportunities of 2026, or whether the market's skepticism is well-founded, is a question only time will answer. Hit like if this gave you a clearer picture of Netflix, and subscribe for more deep dives like this one.